Hello, and welcome to the Joe DeLisi Financial Advisor Podcast. Today, we're going to talk about the U.S. economy's fears of a recession. And depending on when you're listening to this, it might be a fear, it might not, it might already be gone. And that's kind of the discussion point that we want to have today. We're trying something new. We're doing a little video and audio at the same time. Today, there are a lot of numbers. There's a lot of very specific data and pieces that I have to get right. So I'll reference my notes, here and there on this audio. You shouldn't tell the difference. Video, you might. So really the title again is, well, how will or how can we respond to a fear of a recession in the U.S. economy? And it really dawned on me the other day that while we can't predict, if something's going to happen or what's going to happen or when it's going to happen, we can predict how we can react to that situation. And really that's got to come from a place of principles. Specifically investing principles and the science and the math and how we build portfolios and why we do those things really will dictate how we can respond to events that occur. So rather than predicting anything, I just want to apply these principles. And what I did was I jumped online and I Googled specifically this. I Googled U.S. economy, quote, U.S. economy, and this is what I got back. All right. And so number one was U.S. economy. This is a direct quote. U.S. economy is doing better than Americans think, unquote. That was from Newsweek, and that was August 27th of 2024. Right under that, I think it was two under that, I got, quote, famous economist who predicted 2008 recession issues very, capitalized, grim warning over future of the U.S. economy, unquote. And that was from the Daily Mail on August 26th, 2024. So one day apart, two very different headlines, and all I Googled was U.S. economy. So if you're one of those clients of mine who gets fearful or worried or anxious when you're looking on, X or I get a lot of people who email me over Instagram and TikTok posts, or just watching the news in general, understand that just Googling U.S. economy one day apart gave me those ridiculously different results. This is a challenge because evaluating the health of the U.S. economy is really difficult to do in real time. Economic indicators, unlike markets, are backward looking. So markets tend to be forward looking. The economic indicators, again, backward looking. So I wrote this down. The 2020 recession was declared in June, but it was later determined to have ended in April. So 2 full months before the start was announced. Part of the uncertainty has got to stem from really that not all economic measures go south during a recession. This is really important right now because there's a lot of differing economic data out there. For example, recessions are usually associated with negative GDP growth, but GDP changes were positive on average during some recessions, such as 1960 and 2001. High unemployment, this is the one, there's a few actually I want to talk about here, but the high unemployment is also considered a characteristic of a recession. The reality that, like, if you think about it right now, at least as the government reports it, we don't have an era of high unemployment, depending on how you define it. And these are this is the other thing, they're being revised over and over. The job numbers are never, quote unquote, accurate because the government revises them, I think, 15 times out of 16 times. The job data, when it comes out, is revised down. So it's hard to really tell. The other thing that's going on right now, which is interesting, is that if you look at markets, generally speaking, they're going up. If you look at the price of gold, though, it's at near all-time highs. There's just a lot of conflicting data out there in terms of, like, will we be looking at a recession or not? Again, markets aren't going to be able to tell us that because markets tend to be forward-looking, not backward. So really, why even try to predict? I was on a call recently. This is sort of as an aside, but this just happened the other day. I'm working on a new client, a very sizable account, one of the largest I've worked on. And I was speaking to, I can't mention the bank, but I was speaking to a fairly large investment bank. And these folks were currently managing some of the assets for this client. And the lady was very nice. And, we kind of went back and forth on investing styles and how assets should be invested and whatnot. And she was walking myself and the client through what her bank felt was going to happen over the next 10 years. And I just kind of stayed silent for a little bit because I'm thinking she didn't say 10 years. It had to be 10 months. It had to be a year. It had to be something like that. But no, it was a decade. And so again, we went back and forth. And you don't ever want to be, I don't want to be in conflict, especially when the client's on the phone there. My job isn't to make anybody look, bad. But I just had to ask her, I said, hey, would you mind if I took a screenshot, because we were on a Zoom call, would you mind if I took a screenshot of these predictions of where your bank feels that, these different markets are headed over the next decade? And she said, of course. I just asked her at that point, and I was very upfront about it. I wasn't trying to be mean, but I said, look, why would you give this away for free? Why? Well, if you guys knew where these markets were headed in the next 10 years, why would you just let me screenshot that for free? I'm a competitor of yours. Why would you give it to anybody for 1% or 0.5%? Or, if you really knew where they were going, you wouldn't even need to be on the Zoom call. And I bring that up a lot to people, is that it doesn't matter who we're talking about, banks, wirehouses, broker-dealers, Joe, anybody who tells you that they know an event's going to occur, it's impossible. Nobody knows the future. Recessions are clearly in that ballpark too. So, I mentioned a minute ago, do we even worry about predictions? And I don't, because if you Google, like I said before, and you get those two very differing, bookends to that discussion. Yes, the economy is doing great. No, the economy is doing horrible. Does it really even matter? No, it doesn't. I'm going to give you some data on recessions that are going to probably blow your mind. So stick with me on this. We always have a hard time on audio when we use like raw data like this, but it's important to know it. If you consider, so all the data I'm going to give you is the S&P 500. Again, not because I think that is the market, but it's just for brevity's sake. And as you listen, I want you to think about what these returns would mean to you and your reaction to a recession or recessionary fears. Okay, so all of the years I'm going to give you are actual recession years. So we'll start with 1973. 1 year prior to the recession in 73, the S&P 500 was down 18%. During the recession, it was down 13%. 1 year after the recession ended, the S&P was up 23%, and 2 years after, it was up 18%. So, again, for context, right before and during, really bad returns, but 2 years after, significantly positive returns. When we invest, as you know, we're investing long-term. We're not speculating, we're not gambling, we're not trading. An investment is a long-term play. 5, 10, 15, 20 years, really on the latter stages of that is where I prefer long-term investments. 1980, 1 year prior, unlike 1973 where it was double digits down, 1 year prior to the recession in 1980, the S&P was up 14%. During the recession, it was up 10%. 2 years after the recession, it was negative 12%. How do you predict going into these things that it's going to happen and what's going to happen right outside of it? 1981. 1 year prior to that recession, S&P up 8. During, up 6. 1 year post-recession in 1980, positive 20. 2 years post-recession in 1980, positive 18. I'm going to go to 2007. Okay, that really scary time period, 07, 08, 09. So 1 year prior, 2007, the S&P was up 4. During the recession, we all know this. During the recession, depending on when you start and stop this, it was negative 37%. 1 year post-recession, up 12. 2 years post-recession, up positive 44%. You got to stick in it. It doesn't matter what is going on during it. It's like turbulence on an airplane. The turbulence doesn't matter. The only way you make it to your location safely is if you stay on the plane. And so 2020, this one was violent because it was so fast. It happened so quickly. 1 year prior to 2020's recession, we were up 6 in the S&P. During that recession, negative 1. 1 year post-recession, positive 44. 2 years post that recession, we're not 100% exactly sure. Some of the data is not even really out there yet, which is bizarre because it's true. We should have the data. It's an unknown ending yet. Every time I look through this, it's kind of weird to me as we look at that. So I can give you a number, but it's not necessarily accurate. I'm just going to leave it off. Here's what we do know. On average, 2 years after recessions since 1953, 82% of the time, 82, it's a positive return. So 2 years after a recession, 82% of the time, your account is positive. We don't speculate. We don't need to invest. We're not investing money for less than 5 years. And the other thing I'll mention here, because I know I'm going to get this as we wrap this up. If you're 60, 65, 70 years old and you're saying, well, I don't have 20 years to invest, but you do. your life expectancy is 86 plus, depending on the individual circumstances. And so, yeah, you might not be in a 95% all equity portfolio. Maybe it's only 30% or 40% or 50%. But the point is, whatever piece that you do have in equities, that's long-term invested money. And we're not just going to be in the S&P, as you know. We're going to tilt to things like small cap and value. We're going to be in international, emerging markets, et cetera. So we're not just throwing everything into the S&P 500 and hoping for the best. So don't worry about these range of articles that come out when you Google something, and don't worry about what you see on X or Instagram or TikTok or what you hear from your neighbor, at a Labor Day party or something of that nature. Just you have to stick with what the science and the math says. And when you build a portfolio that is built on that, and we follow the investment policy statement that all of you have, that portfolio and that investment policy statement will fund your income policy statement in distribution. That's the most important part. You got to have enough money to live that life for the rest of your life the way you want to. That's it for today. Probably 2 weeks, we're gonna come back and look at some presidential data and see where we are in the race, and hopefully allay any fears as to how that race is going, because we got to look at the Senate and the House as well. Now for some compliance. Industrial production, inflation, and unemployment are based on monthly data from the Federal Reserve Bank of St. Louis. Gross domestic product, GDP, is based on quarterly data from the U.S. Bureau of Economic Analysis. Quarterly data is not available prior to 1947. Registered representative, financial advisor, Park Avenue Securities, LLC, Pass OSJ 5280, Carroll Canyon Road, Suite 300, San Diego, California, 92121. 619-684-6400. Security products and advisory services offered through Pass, member FINRA, SIPC, financial representative, the Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. California Insurance License Number, OD34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that the individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Pass, Guardian, or Westpac Wealth, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value, both due to real and perceived general market, economic, and industry conditions. This material is intended for general use. By providing this content, Park Avenue Securities, LLC, and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged, and one cannot invest directly in an index. 7003344.1 expires 9/2026.